Hey everybody. So as we watch the press, there are a number of different things that are influencing our decision when we consider the markets. We've got the major banks coming out and saying market's going to increase a little bit, then probably drop off. There are mixed signals coming from the RBA currently holding cash rates, but there are some pressures that they will want to increase it. We're seeing the banks change their tune regarding lending, making it tighter, credit a little bit harder. The government is talking about opening up the borders, allowing skilled migrants to come in. And all of this, we are facing a time where property prices are moving much, much faster than wage growth. So there's just so many competing energies, not to mention the new variant of the Omicron. I hope I pronounced that correctly, virus or variant. So what I wanted to do today is walk through a little bit of reporting, have a chat about some of these articles, give you some of my thoughts, and then if you've got questions, leave them in the comments below so that we can flesh out what we're seeing in the media today. Now, some of the reports are a little bit older than others. I wanted to take my time to read and really go through it. I really like this monthly hedonic home value index, which comes from Corelogic. Now, here, housing values have continued to rise through the month of November, but conditions are diversifying as stock levels rise and affordability pressures mount. So, what they're saying here is that Australian prices increased in November, but that's come off of so it's growing, but growing much, much slower than it has in previous months. So the national housing values have grown by 22% over the past 12 months. That's a crazy amount of growth. Nationwide, mind you, nationwide growth, 22% is extraordinary. So this is what we're just saying, that the peak of growth was in March, where prices grew by 2.8%. This is an extraordinary amount of growth for 1 month, because especially in a normal sort of cyclical pattern, we might see 2.8% growth in a whole year. Now, the reason why growth is starting to slow down, Tim Lawless says here, virtually every factor that has driven housing values higher has lost its potency over the recent months. Credit's the first one. Fixed price mortgages are getting higher. Higher listings, that means there's more listings available, more supply is coming into the market, and affordability has become a substantial barrier to entry. So basically, prices are high, credit is getting tighter. Now, it is important to note that all markets haven't grown equally, and they are all moving in similar but also different behaviors. Brisbane and Adelaide are the only capital cities to experience a slow growth, to not yet experience a slowing growth. The reason being is that Brisbane values grew 2.9%. Adelaide grew 2.5%. Extraordinary growth. The reason why these markets are still growing quite strongly is because supply dynamics are still quite tight. So in those markets, let's go here, total stock available for Adelaide was 32% lower than the average, 5-year average. In Brisbane, 33.9%. Anecdotally, we're talking to developers, agents, landowners. There is just not a lot of supply in this market, both on the open market, but then also for brand new listings, brand new developments and land releases. It's very, very tight out there. Some developers are just simply increasing land prices by as much as 10 or 15%, just because they can. If you sit on a contract for too long, they're just increasing the price. This is a little bit concerning for me. I mean, the other thing is that build prices keep on going up. So the new market, prices just keep on going up and up and up. Where if you have a look at Sydney and Melbourne, those two markets, let's just have a look. Here we are. Total listings, just 2.6% below the 5-year average. So we're about the 5-year average. And then Melbourne, there's a lot more listings available. They're above the 5-year average. So those two markets haven't grown quite as strong. Just going down the line, some of the big winners: Sydney, total return 2.8%. Brisbane has been a massive earner. Melbourne has been quite soft. As with Perth, Hobart has done extraordinarily well. So has Canberra. So when I look at these numbers, I do see opportunities. You would say Perth and Melbourne, but between the two of them, I'm more bullish on Melbourne just because, as we both know in past reports, Melbourne has lost a lot of people domestically. People have fled the Victorian market, moved to Brisbane, which has again added a lot of pressure here. Brisbane has also had a lot of pump up because of the Olympics. So a lot of people have been moving to Brisbane. Sydney's just one of those crazy markets that always performs. And then the reason why we're seeing such crazy growth out of these two markets, Hobart and Canberra, is one, they're operating off a low base. Look at the median house prices in Hobart. So there's a lot, it's easier for a small number to grow, $50,000 or $100,000. So it moves quite significantly. There have been a lot of investors moving into these two markets, but Canberra, again, is a very tightly held market. Not a lot of stock comes on. The government actually slowly releases lots, and they've got a very tightly held market. Now, let's talk about, here we go. Base and median values, capital cities now 37% more expensive, or their houses are more expensive than units. The largest difference on record. So the difference between houses and units is extraordinarily large. It's never been this wide. Across all of them, it's averaged at $240,000. In Sydney, the gap between houses and units is the widest as a dollar term at $523,000. It's almost the price of a unit difference between a house and a unit. When I look at this, I really do see this as a massive opportunity. We've been saying it for quite a while. Now, Tim Lawless is now saying it as well. With such a large gap between broad housing types, it's no wonder we're seeing a demand gradually transition towards higher density simply because it's more affordable than buying a house. And this is the case. We've been saying it a while. I think that this trend will continue to go. Now, there's lots and lots of data in here. I won't go through all of it. One thing I will talk about here, the trend in rental growth has been reasonably firm through April, with most monthly changes in the national rent holding between 0.6 and 0.7. This is well above the decade average of 0.2%. So rents are starting to grow. And I will say that we will see this number increase quite significantly, especially when the borders open up. I keep on saying this. Now, let me just jump to this article because it's relevant. Now, back in December, skilled migrants, international students, and refugees welcome back into Australia from December 1. Students is huge, and skilled migrants. They want to allow. There have been some slight changes because of the Omicron variant, but federal government has an estimated 200,000 migrants holding these visas will come, expected to take up this offer. A huge amount of these people will traditionally go to Sydney and to Melbourne. Skilled migrants will move towards more affordable options. So you're going to see density and distance. Outer city fringes, but then also apartments are a huge popular thing. So when they come in, they're going to suck up a lot of that rental demand. And I do think we're going to see rental increase quite significantly, especially when students come in. They do like to be in city centres near train stations. They haven't got cars. So they will put a lot of pressure on apartment rents. And then when tourism comes back, that's another one. Tourism sucks up a lot of apartments as well because they're going to take all the Airbnb listings back. A lot of listings will go back to Airbnb, which takes a lot of supply out of the market. Prices will increase. That's a massive opportunity. Just very quickly, if you didn't see it, they did choose to hold the cash rate. There's nothing really changing there, but there are some pressures that this will change. They're waiting to see headline CPA to move between the 2 and 3%. It's still quite low at 2.1%. They want it to get much higher. And they do want to see its target to return to full employment and consistent inflation before they start to change that interest rate. But we are also influenced by external powers such as the US and China and the UK and the European financial systems. But at the moment, they're saying they're not going to change it. This may change next year. One thing I wanted to just show you, this is a really interesting statistic or thing to think about. How much has house price growth outstripped wages? Now, let's have a look here. Wages has increased 81.7% in the past 20 years. House values have grown by 193%. This is just going to keep on getting worse. Now, you're probably saying, well, Dom, with all this information, what the hell do I do as a purchaser and investor? Well, I can understand why you might want to sit on the fence, especially when you're reading news articles like this, where CBA predicts a house price to drop by 10%. And then, a lot of the other banks are kind of saying similar things. Westpac dwelling prices to go up 8% and then down 5%. So there's going to be a net 3% increase. ANZ assertion, 6% rise before dropping 2%. So the banks are kind of saying next year we're going to see a modest rise, but then a drop off. And I believe that they're saying that this drop-off is going to be largely due to credit being tightened. My view in all of this is that these are national figures, and this is going to be largely driven this drop-off is going to be largely driven to an increase in supply, but then also interest rates going up. Credit getting tighter and it harder for people to go buy properties. Now, these properties, I think that there's going to be certainly less people buying properties, but two things happen. If people aren't buying properties, then they're going to rent. So that means that you're going to see increases in rental demand. The other thing is that I think that a lot of people are going to shift, as we've said before, shift the demand away from higher priced properties towards more cheaper ones. I think we're going to see a massive amount of demand go towards cheaper priced units, cheaper priced properties on the fringes, also townhouses, from both investors and owner occupiers. So we're going to see a flight to, before it was with COVID, it was a flight to quality and it was a flight to space. Now it's going to be a flight to affordability. So though we're going to see some price changes going down by 2023, I do believe as a strategy or as a targeted growth, I believe some areas will actually see some really strong growth. Now back to the previous slide, if you sit on the fence, as time goes on, it's just going to get harder and harder for you to go and buy the same property. That same property is going to grow faster than your wage growth. So I don't think you should sit on the fence. I think you should be strategic. Work with us. This is a bit of if you're not going to work with us, it's fine. But get out there, buy some affordable property that is going to have strong rental growth when we see migration open up, tourists come back, and students come back. So that's my breakdown, 15 minutes. I hope it hasn't been too long. Any questions, let me know. If you disagree, also let me know. This is how we flesh out our thoughts. And if you think there's some value in here, send it to your family, friends, and maybe some of that barbecue chat. I hope you picked one or two good things up out of this analysis. Have a great week. Have a great Christmas, New Year if I don't see or hear from you. See you later.